There may be a recession. It has been dubbed the most telegraphed recession in history. Investors have lots of cash on the sidelines, waiting for the negative earnings revision cycle. The good news is that investors have been expecting earnings growth to slow since mid-2022. The upcoming earnings seasons may result in more short-term volatility, but it is a necessary step to build the foundation for sustained recovery, and opportunities can be found during this process. We expect to see more downward earnings revision during the first half of 2023. This could spill over into the second half if the economic slowdown is deeper than expected. But the slowdown could be softened by China's economic reopening and the relative resilience of both the US and European economies. The consensus estimates for the S&P 500 has been coming down since mid-2022, and many companies have already announced layoffs and cutbacks to spending to protect margins and earnings. Much of the negative news may already be priced in, but until we get through the next few quarters of earnings, it is still a bit of a wild card. Some of the risks that we are monitoring include geopolitical risks due to the ongoing Russia-Ukraine conflict. Energy prices have come down recently, but volatility could linger if the conflict drags on and if the winter is harsh. Another risk is the reopening of China and the relaxation of its zero COVID policy. Although this should be a net positive for the global economy, risks remain with new COVID variants spreading and concerns linger over China's property market. We continue to see the ongoing build-out of AI infrastructure to be a necessity as AI progresses from the pilot stage to mass deployment over the coming years. Amongst the longer-term areas of interest are 5G and 6G, the Internet of Things, edge computing, electric and autonomous vehicles, and leading-edge manufacturing. There are also macroeconomic factors that could propel AI forward. In AI-enabled industries, labor shortages, wage inflation, and demographic issues should be tailwinds for greater AI investments. Companies need to enhance productivity and do more with less in a slower economy. The automotive, consumer, healthcare, and financial services sector already appear to be benefiting from their AI investments. We expect to see more industries roll out AI initiatives across more of their operations to accelerate their digital evolution. Despite a difficult performance environment for growth stocks in general, AI continues to be a transformational force. More and more companies are using AI for cost reduction, revenue enhancement, and improved customer engagement. And the number of use cases continue to grow rapidly. This is providing many opportunities. This view is supported by recent research from McKinsey & Company. They found that the number of organizations embedding AI into at least one business function has increased from 20% to 50% over the last 5 years. Moreover, Price Waterhouse found that companies with a holistic approach to AI are seeing greater success than companies that are using AI to tackle a single business function. Overall, we continue to believe we are at the very early stages of massive disruptive change brought about by the advancement and deployment of artificial intelligence. In this phase, slow and steady may win the race.